So direct materials, direct labor, and factory overhead will be a part of our product cost. Very good. Okay, so the last thing we're gonna do for our review today is this one, question 5. This one I'm gonna ask you. If you want extra practice, try to do this question. If you do this question and you feel like you're comfortable or you have questions, what I'm going to do is I'm going to do a video of me solving this question so that you can double check your answer when you're done. So let's look at number 5. It's asking us to compute the cost of goods manufactured and the cost of goods sold from the following amounts. Okay, so we have direct materials beginning and ending inventory, work in process inventory beginning and ending, finished goods inventory beginning and ending, purchases of direct materials, direct labor, and manufacturing overhead. Now, the first thing we need to realize is that the cost of goods manufactured, the formula is total manufacturing cost plus beginning WIP, work in process, minus ending WIP, okay? Another way to think of work in process is unfinished goods. So total manufacturing cost plus the beginning unfinished goods less the ending unfinished goods will give you cost of goods manufactured. But as you see, we don't just have a total manufacturing cost. This right here is missing in this equation. We know what our beginning WIP is, right? 38,000. We know what our ending WIP is, 30,000. The only part of this equation to find cost of goods manufactured that's missing is the total manufacturing cost. All right, the total manufacturing cost. So with that being said, how do we calculate the total manufacturing cost? And the total manufacturing cost is direct materials used. Remember I said direct materials used plus direct labor plus manufacturing overhead. These three things is what's going to give you total manufacturing costs. Once you get total manufacturing costs, plug it into this formula here and you can come up with a cost of goods manufactured. With that being said, who can tell me how we find direct materials used? Now, direct materials used is very similar to what we know in our income statement when we did the income statement in the financial accounting part as the cost of goods sold. The formula for that is very similar, right? So if we know the direct materials that we had in the beginning of the year, and we know the direct materials that we purchased, and we know the direct materials that we had at the end of the year, how do you think we find the direct materials used? Someone says, subtract the unfinished goods. Okay, so we're gonna less. All right, so that's part of the equation. Part of the equation is less the ending direct materials. All right, but what's the first part of this? What do we start with? When you're finding cost of goods sold, what do you start with? Beginning inventory. So that's the same thing we're gonna do here. We're gonna start with exactly direct materials from the previous year, which is the beginning materials inventory of 22,000. And then we're going to do what next? What do we do next when we're finding cost of goods sold? We add the direct materials that we purchased, which is $75,000. $75,000 worth of direct materials, which gives us the direct materials available for use. This is how much we have to use, all right, which is a total of 97,000. So as our friend said, you kind of went backwards, but that's okay. You gave us a part of it that we needed. We're going to deduct our ending direct materials, and our ending direct materials is 26,000. So this is going to give us the direct materials used. So how much is this? Does this make sense to everyone? It's just like the one we did when we did cost of goods sold. Just the same. Yes, good. So now we have direct materials used. So we can add in our direct labor and our manufacturing overhead, and we have our total manufacturing cost. What's our total manufacturing cost? Who can calculate the total manufacturing cost? So 71,000 plus 82,000 plus 39,000 is going to be equal to $192,000. All right, it's confirmed. Perfect. So $192,000 includes the cost of finished and unfinished goods started this period. The total cost of the finished and unfinished goods, right? So this total manufacturing cost not only includes the cost of the goods we finished, but it also includes the cost of goods that are not finished as yet. But the cost of goods manufactured is only interested in the cost of goods that are finished. So this is why we have our formula of total manufacturing costs of 192,000 plus a beginning work in process of 38,000, and we deduct our ending work in process of 30,000. Can somebody tell me what the cost of goods manufactured is if you calculate it? $200,000. So that's our cost of goods manufactured. Does that make sense that this is now only the goods that are finished? So basically we're saying the total manufacturing cost is the cost of all of the goods that we have started and finished this period, plus the goods that we started last period, right? And then we're going to deduct what's left in ending with, which means these are the things that are still not finished at the end of the period. Once we take out what's still not finished, once we deduct all the things that are unfinished, we should be left with what's finished. So $200,000 is $200,000 worth of finished goods, okay? So then at this point, we're going to take that $200,000 of cost of goods manufactured, and we're going to put it into a formula that helps us to calculate our cost of goods sold. But before we calculate our cost of goods sold, are you okay with this one? How we go from total manufacturing costs, we find the cost of goods to find the cost of goods manufactured. Now we're going to use the cost of goods manufactured in order to get our cost of goods sold. So how do you think we're going to find the cost of goods sold? I'm going to try to put everything on this one slide. It's very similar to the cost of goods sold one that we did before, right? And you know what the cost of goods sold, what does it start with? Tell me. What's the first thing we do to find cost of goods sold? Beginning inventory, very good. Now, which inventory is it? Is it beginning with, beginning direct materials? It's beginning finished, very good. So beginning finished inventory of $18,000. And then what are we gonna add? What do we add? We are looking at the goods that were finished from the previous period, right? What do you think we're gonna add to goods that are finished from a previous period? We're trying to find out the cost of goods sold in this period. We just put in beginning finished inventory. That means that all the goods that were finished from the previous period, we just added it there, 18,000. What do we add to that? We don't add our ending finished, we take that away always. So that goes somewhere down here, less ending finished. So let me tell you, in a merchandising company, we will add our purchases, right? If we were just buying goods to resell them, we're gonna add our purchases to that. But this is a manufacturing company. So we didn't just purchase to resell, we have to manufacture to resell. So we're going to be adding our cost of goods manufactured of 200,000 to this. This gives us our cost of goods available for sale. How are we feeling so far? Only one person feels good, 2 people? Kenza, how do you feel about that?
I kind of lost it with the cost of goods manufactured that we added in there.
Okay, so I want you to think of cost of goods manufactured as the cost of the goods you finished in this period. All right? So we want to find out how much goods do we have available to sell? Well, we got the goods that we finished last period that we didn't get to sell, so they come into this period. We have those goods. And we also have the goods that we finished in this period. So when we combine those together, that's the cost of goods that we have available for us to sell. Cost of goods manufactured is the same as saying the cost of the finished goods in this period. So the cost of the finished goods that we brought in from the previous period, plus the cost of the goods that we finished in this period, tells us the cost of goods that are available for us to sell.
So if I'm just doing a comparison, if this would be where we do add purchases from this year. So this portion is equivalent to that in a manufacturing.
Yes.
Okay, perfect. Thank you.
You're welcome. So because we know in merchandising, we have purchases. We just purchase the clothes and sell it. We don't have that luxury in manufacturing. We have to actually produce the goods. So it's equivalent to purchases. So add cost of goods manufactured is just like saying add your purchases in a merchandising company. So this gives us a total of $218,000 available, and we deduct our ending finished goods inventory, which is $23,000. And can somebody tell me what is our cost of goods sold? 195, okay. All right. So you see how we kind of broke that down? We started with total manufacturing cost, plugged that into the cost of goods manufactured formula, calculated cost of goods manufactured, then plugged cost of goods manufactured into cost of goods sold formula to come up with our cost of goods sold. Do we see how those things tie in together now? It should be a little bit clearer than last week because it was at the end and we were tired. All right. Okay, so with that being said, this table right here is also, I just copied it from the previous week. I just brought it here. It just shows us exactly what we did. So we found the materials used here, make it bigger. We calculated the direct materials used, right? We added it into our direct labor and manufacturing overhead to give us total manufacturing cost. Then we used a formula to calculate our cost of goods manufactured. Then we put this cost of goods manufactured into here, our income statement, to come up with a cost of goods sold. And once we came up with our cost of goods sold, then we were able to, well, then eventually you'll get to your operating income. Once you have your cost of goods sold, you deduct any selling and administrative expenses or your period expenses, and then that will give you an operating income. Okay, so that is it for the review from last week. Now let's move on. Chapter 5, costing systems. So these are some of the terms we're going to be talking about, not just in today's lecture, but with Taslima, you will look at process costing, and you'll also look at job costing with Taslima. We'll talk about it very, very briefly, just to understand what they mean in this lecture. But our major focus is on chapter 5, activity-based costing. And so we'll understand what all of these terms mean very shortly. Right now, you probably don't know a lot, and you don't know more than what you've studied in your textbook, or maybe you watched Taslima's lecture before you coming to this one. But we're gonna try to learn as much as we could about these concepts now. So job costing. Costing is the process of accumulating and classifying products cost of products, services, and projects. So we have a product and we want to figure out what the cost is to produce that product or that service or that project. We're going to go through a concept called costing. What costs make up product costs? And we already know that. What are the three costs that make up product costs? We know that the first one is direct materials, direct labor, and manufacturing overhead. We know that. We also know that direct materials and direct labor are easily traced to the cost object or easily traced to the product or the service or the project. Direct materials and direct labor, we have no problems with those trying to figure out how much of that cost each unit absorbs. It's easy, we know. The one we don't know very easily is manufacturing overhead, because this cost cannot be traced easily to a unit of product. We have to allocate these costs to a cost object. So because we cannot trace, we have to allocate. So we're going to be learning about how we allocate in today's class. Now, I'm going to play this quick video that's going to tell you a brief comparison of job costing and process costing and how they're different. But I'm going to give you a quick preamble before you listen to it. If you see here, there's a cake. There's some cakes, right? Custom-made cakes. And this job costing is what we'll use to cost each of those cakes. And then over here, you see on the assembly line, a bunch of Coca-Cola bottles. And process costing is what we're going to use in order to cost each of these Cokes. So how much does it cost to make one bottle of Coke? How much does it cost to make the other bottle of Coke? How much does it cost to make that bottle of Coke? Well, do you think that it'll cost exactly the same to make each bottle of those Cokes? What do you think? Each bottle of Coke, of the Cokes on this thing in this machine, are they all going to be the same cost to make each one? You think one of those bottle of Cokes costs more than the other one? No, I don't think so either. I think those Cokes look exactly the same. So they're all going to cost exactly the same to make each one. All right. So in a situation like that, where you're creating a mass production of the same thing over and over repetitively, you're going to use a process called process costing in order to cost those. Okay. And you'll learn that later down with Taslima after reading week. Now, on the other end, you see these custom made cakes. Do you think all these three cakes cost the same to make? No, the cakes are all different. If you've had a birthday or a wedding or anniversary or whatever, and you've ordered a cake from someone, they're going to give you a specific quote for your cake, and it's going to be different than the birthday cake that I ordered, because it's just different size, different complexities, just different flavors. It's just different. And so because you're making these specific products or service, you're going to be using a process called job costing.
In this video, we're going to talk about the difference between job order costing and process costing. And the main key difference between these two cost flow methods is job order costing, we're talking about heterogeneous products. And what I mean by heterogeneous is we have a firm, for example, that is selling, let's say, custom-made furniture. Custom-made furniture. So when we have a customer that submits an order, let me just change colors here. When we have an order come in for furniture, that order is going to be different than yesterday's order, right? So it's not going to be that we're just having the same kind of product that we're shipping out all the time, right? So this order might be for a custom couch, and then we might have another order for custom love seats, right, or a table. And so we're going to have, with these orders, we're going to be putting our costs that flow through our raw materials and all these things, they're going to be flowing through our plant in terms of job cost sheets, excuse me. So we'll say, like, okay, we've got a job cost sheet for an order. We'll say, like, this is order 512B. and then what we're going to have for raw materials, direct labor, and our manufacturing overhead. And we're assigning it to a job, right? So I said order here, but maybe a better way to think of it is job 512B. I'll just put, so we've got job 512B. So we've got a job, a specific order that is going to have its own raw materials, direct labor, manufacturing overhead that's not necessarily the same as another order. So what we're talking about is heterogeneous, is talking about like different types of products, so we have to go through these jobs. If say job 512 was this, job 513 was this, we can't just treat them all the same. But with process costing, we're dealing with some kind of product like maybe oil, right? Where we just say, okay, look, oil is oil, and we really, any order, it might be more oil that somebody's talking about that they want than some other firm, but ultimately it's just oil, right? It's not, it's kind of like these custom items that we got to account for differently. It's just oil. And so it's what we would call a homogeneous product. And it doesn't have to be something like oil. It could be, for example, a toy car. So let's say that your firm only makes one type of toy car. Okay, so we're not talking a multitude of toy cars or custom to just one standard toy car, right? So you might have in this front, we say, okay, well, how are we going to do the cost flow now? Well, we're not going to do it by jobs, right? So the costs here are by jobs. And with process costing, it's by department. I'll just abbreviate that here. So the costs are organized or flow through departments. And what I mean by that is this. So these toy cars, let's just say we look and we say, oh, we've got three departments. We've got assembly of the toy car, right? We put the toy car together, and then we've got painting of the toy car. So after we've assembled it, we paint it, and then we have finally packaging, right? We have to sell it. We put it in some plastic wrap, so we have these three departments. These are our departments. And costs flow through these departments, right? We don't do jobs in the sense. We're not going to have a job 512B and so forth. We're actually having the cost flow through these departments. And what does that mean? Well, just briefly, and see our video on process costing if you'd like to learn more. But the idea is when we requisition materials or apply labor, it gets put into this assembly account, right? We requisition some materials that we need to assemble. They go into this assembly account, and it's going to be a WIP account just for assembly. And then we're going to have a WIP account, and by WIP I mean work in process, a work in process account just for painting. And then we're going to have a work in process account just for packaging, right? So when we start assembling, we say, okay, well, we've assembled some materials here. We're going to debit WIP assembly, and then credit, the raw materials or whatever it is we used.
All right, I'm just going to stop it there because it's starting to talk about debits and credits, which I said that we're not going to be using for the purposes of our course. So just you have an understanding of, we use job costing for some situations and we'll use process costing for other situations. Understanding exactly which situation you will use which type of costing system is really all you need to know for this slide. Okay, and then I have here a table that I created. So if it's a construction company and the product is a customized product, which type of system do you think we'll use? Job costing, very good. Very, very good. Custom furniture, what do you think? Job again, good. Medical services, job costing. Bottling company, process costing, good. And a paper product, process costing, very good. So we understand when we use which one, perfect. Okay, so here I have a flow of costs. Materials, storeroom, flowing to a production department, flowing to the finished goods storeroom, flowing to the delivered to customers section, right? So physical flow usually matches the cash flow. And I'm going to tell you how that happens. Okay. So when you do get this slide, you'll see that I put in the comments under here an example of the flow and how it works. So the material storeroom has direct and indirect materials. Okay. So in the material storeroom, we're going to have direct materials. If, for example, we are a custom cake company, custom cakes, so it's job costing, right? So in the material room, we have eggs, flour as direct material, and then we have cooking spray for the pans as our indirect material. So our indirect and direct materials are in this material storeroom. So whenever we get a cake order, right, the eggs, flour, and cooking spray get moved physically. So they move physically out of storage into the production department. Whenever we get an order for a cake, we're gonna have to go to the storeroom and bring in all the materials that we need, and they're gonna sit in the production department. Now, think of the costs. When we purchased our materials inventory, materials like the eggs and the flour and all that, the cost of these are gonna be in the materials inventory. We're gonna put them in an inventory account called materials inventory. Now, the same thing happens when somebody decides to order from us a cake, the cost comes out, well, not all of it, the ones that we need for that particular job, comes out of materials inventory and moves into a work in process inventory account. Work in process, because we're now working on making this cake. So the costs move from materials inventory account to the work in process inventory account. And what happens at this point is we're going to add our conversion costs, which is direct labor and manufacturing overhead costs, to this cost of our what's already in our work in process inventory, which is our materials. And we're gonna use those direct labor and manufacturing overhead to convert our eggs and our flour and whatever other materials that we're using to bake into a finished product. So once we've finished converting it into a finished product, it moves into a finished goods inventory. The same thing happens physically, where the cake moves physically into the finished goods storeroom. Anyone who's ordered cakes or worked with someone who's baked knows that you have to be very careful about the storage of your cake, because you can bake a very, very pretty cake and decorate it really nicely. And if you store it in a temperature that's too hot or too cold, then your cake can start to move and it can fall apart. All right. So as the physical cake moves out of the production department when it's done, it goes into the finished goods storeroom. So does the cost. Once the cake is finished, the cost of the finished goods goes into an account called the finished goods account. So always in the finished goods inventory will be cakes that are done. Always in the work in process inventory will be cakes that are not done and still in progress. And always in your materials inventory would be the materials that you purchased in order to produce your cake. Okay, so then after that happens, once the person comes to pick up their cake or we deliver it to them, then this finished goods storeroom, the cake goes into the customer's hands, it's delivered. The same for the cost. Once the customer has collected the cake or we've delivered the cake, the cost comes out of finished goods inventory and it moves into the cost of goods sold account. All right, are we okay with that? That will break down there. Okay, Tharun says yes, yes. Okay, perfect. So I have a couple, 3, 4 yeses. All right, so that makes sense, right? So this brings us to the overhead application methods. All right, so in order for us to allocate manufacturing overhead, we've already understood that manufacturing overhead, we cannot easily trace it. We have to allocate it, like the electricity in the factory. The electricity in the cake factory, right? So we're in the kitchen, the factory, the cake factory, and we're making 5 different custom cakes, right? The electricity is on for the whole day while we're working on these 5 different cakes. So now at the end of the day, can I say, okay, I think let's put $20 in of electricity for this cake. Let's put $50 for that cake, $40 for that cake. We can't just figure out how much of the electricity is going to be directly traced to each of the 5 cakes we made. So we have to find a way to allocate that overhead. And the way that we do it, we can either use a volume-based approach or an activity-based approach. Quickly, I'm going to tell you what the volume-based approach is all about. And what this basically says is that you're going to use the number of units that you have made and then just allocate the overhead cost equally to each of the cakes. So for example, if your total manufacturing head cost, including utilities, including depreciation, including your not your baker's salary, including your office booking person salary, or your receptionist salary, and all those people who don't touch the cakes, that total manufacturing cost is $100, okay? If we were to use the volume-based approach, the old volume-based approach, we can just say $100 divided by 5 cakes. And then, so we're gonna put $20 of our overhead cost to each of the cakes. But let's assume that one cake was super big, like it was one of those 10-tiered wedding cakes. And another cake was just a little 6-inch cake. And another cake was a medium-sized cake. Is it fair for us to just equally allocate the overhead costs to each of those cakes? Is that fair? So we can see that that is not fair at all. It's not fair. It's, in fact, it's very inefficient. So they decided we're going to make it a little bit more efficient. And what they did was they improved the allocating a bit, and they decided, let's pick a cost driver. A cost driver is something that drives a cost up or down. And the cost driver that they said we can use is the direct labor hours. So what we're gonna look at is, okay, we got 5 cakes. Let's bring it down to 2 cakes just for explanation purposes. We got 2 cakes, a wedding cake that has 12 tiers and a 1-tier cake, okay? Let's figure out how many hours did we use to make the 12-tier cake? Okay, let's say we used 15 hours to create the 12-tier cake. And how many hours did we use to create the 1-tier cake? Let's say it took us only 2 hours. Then if we see 2 hours of direct labor for the small cake, 12 hours for the big cake, then we know that if we use direct labor hours to allocate our overhead, then which of those cakes will absorb most of the overhead? The wedding cake is going to get most of the overhead costs because it has the most labor hours. Is that a little bit more fair now? Because we will think, if you're spending that many hours working on the cake, you're definitely using up a lot more electricity that day. Whereas at the smaller cake only used 2 hours of electricity, so it should not have as much of the overhead costs. Are we good with that explanation? Makes sense, perfect. All right, so I'm gonna play this video and it talks about volume-based versus the activity-based approach. We can see that the activity-based approach is even more efficient than just using one cost driver. As I said, a cost driver drives costs up or down. So if we notice that by using a cost driver like direct labor hours, it makes the allocation of the cost of manufacturing overhead to each product more efficient. Well, activity-based approach is even more efficient because of instead of just using one cost driver, we end up using multiple cost drivers, okay? So we'll talk about that more as we go along. Just to reiterate what I just said.
We're going to discuss cost drivers. So a cost driver is just an activity that causes cost to occur. So if we're thinking about an ice cream store, the more ice cream cones that they make, the more costs that they're going to have. right? Some common cost drivers that you'll see in practice are the number of machine hours. So if you think about running a machine for 10 hours and you have a certain amount of cost, if you were to run the machine for 1,000 hours instead of 10 hours, you probably have a lot more maintenance costs and so forth. So therefore, we'd say that the number of machine hours could be an important cost driver, because when there's a change in the activity level, and by activity level, we mean like the number of machine hours, or we could have something else like the number of direct labor hours, the number of units produced, if we're thinking about the ice cream cones, number of employees, any number of things. When there's a change in the amount of that activity level, then we're going to see a change in the amount of costs. And so that's the whole idea behind a cost driver, is there's this cause and effect relationship. The activity happens, we make an ice cream cone, that results in costs. Now, this is going to be a really important concept, because traditional costing systems typically just have one cost driver that they identified and used to apply manufacturing overhead. So they just take something like machine hours and say, okay, that's the cost driver. And so whenever this occurs, that's what we're going to use to apply manufacturing overhead, which we'll talk about in future videos if you're not quite too clear on that. But basically, they just use one cost driver, and we said, you know what, actually, there are a lot of different things that, we might have this thing over here, this activity 1, activity 2, activity 3, activity 4, 5. There might be 5, 6, 7, 10 different cost drivers that are actually affecting costs for the company. So if the company wants to do a really good job measuring costs and figure out what is the cost per unit produced and so forth, then they really need to get a handle on these cause and effect relationships. And that led to the development of activity-based costing, which is a lot more precise and actually takes into consideration a number of different cost drivers. And we'll talk about all these concepts in the videos to come.
So any questions so far on that? We're gonna start looking at the first assigned problem for today, which is exercise 520. And we're only gonna be looking at part A, because part A is what gives us practice on like the volume-based approach, the traditional approach. So exercise 520, if nobody has any questions. So review and practice, we're looking at 520, not 523, exercise 520. Okay, so exercise 520, we're gonna do part A. So Alonzo, I gotta share this with you again so you can see. Alonzo Inc. manufactures 2 products, car wheels and truck wheels. To determine the amount of overhead to assign to each product line, the controller, Yuyu Ortega, has developed the following information. So estimated wheels produced are 40,000 for the car, and they produce 10,000 wheels for trucks. Direct labor hours per wheel, they use 2 direct labor hours to produce one of these wheels. And they use 6 direct labor hours to produce one of these wheels. The total estimated overhead costs for the 2 product lines are $840,000. Now let's just stop there. $840,000, right? Which one of these types of wheels, the car wheels or the truck wheels, do you think should get most of the overhead costs? A guess, give me a guess, what do you think? Truck, car. Some people say car, some people say trucks. All right, cars, lots of people saying car. I guess you're saying car because we produced more of it, right? And some people are saying truck because it uses more direct labor hours per wheel. Okay, I just assume that's why you picked those. It makes sense. So calculate the overhead costs assigned to the car wheels and truck wheels, assuming that direct labor hours are used to allocate overhead costs. So we are going to be using direct labor hours to allocate that $840,000. We understand the assignment? We understand what we're set out to do. What do we have to do? We have to allocate our overhead cost of $840,000. We need to figure out how much of overhead goes to the cars, how much goes to the truck. We get that, right? That's what we need to do. Anybody lost right now? Lost, okay. Good. Thank you for stopping me here. See, I could have went on and nobody would have told me. So $840,000 is your overhead cost, Effie and Alyssa. $840,000 is your overhead cost. These are indirect costs. These are not easily traced to our product. These costs we need to allocate. We need to know how much goes to the car. We can't do 50-50. That's not fair, right? So we have to think of a more efficient way to allocate the cost. And so we're going to use direct labor hours to help us figure out how much goes to car and how much of the $840,000 goes to the wheels for the truck. Does that make sense so far? Good, great. So what we're going to do is we're going to have to find something called a predetermined overhead rate. Predetermined overhead rate. I'm gonna write that down. Predetermined overhead rate. And the predetermined overhead rate is equal to budgeted total overhead costs divided by a budgeted total cost driver. So do we have the budgeted total overhead costs? What's our total overhead cost? Budgeted also means estimated, right? We estimate that overhead cost will be about $840,000. Good. Now, we also estimate that direct labor hours for the car and the truck will be 2 hours per wheel for the car and 6 hours per wheel for the trucks. But for the formula, we need a total cost driver. How will we find total cost driver here? The cost driver is direct labor hours, okay? It says so right there, and your question in your exam will always tell you what the cost driver is. What is going to be driving these costs? The question says direct labor hours will drive the cost. Use the direct labor hours to allocate the overhead cost. So we know the cost driver is direct labor hours. We need a total direct labor hours. Total estimated direct labor hours is what? 8 hours per wheel. But I want a total direct labor hours. How much did we use for the car? Just 2 hours? How many hours did we use for the car wheels? 80,000, very good. 2 times 40,000 wheels, 2 hours per wheel times 40,000 wheels equals 80,000 hours. How many hours did we use for the truck? 60,000. So what is 80 plus 60,000? 840,000 divided by 140,000 hours is equal to, what is our predetermined overhead rate? $6. $6? Is that what you're saying? $6 is the answer for that? Okay, so $6 per what? $6 per something. $6 per, what did we divide by? We divided by total, exactly. We divided by total labor hours. So $6 per labor hour. That's what we're going to use to allocate to our different products. So cars, car wheels, and truck wheels, right? Car wheels How many hours did car wheels use? Because remember, it says $6 per labor hour. So how many hours did car wheels use again? 80,000 hours. So 80,000 hours. And how much hours did we use for trucks? 60,000 hours. So we're gonna multiply these hours by the predetermined overhead rate. So that's times $6 times $6. And then, so what is this total here? 80,000 hours times 6, $480,000. Oh, that's not a 4, it's a 2, $480,000. And how much is truck for the truck? $360,000. Great. So when you add these two up together, you should get $840,000, right? So of the $840,000, $480,000 goes to car wheels and $360,000 goes to truck wheels, right? So remember what you guys guessed before. Now we know the wheels that got the most were the car wheels. They got the most of the manufacturing overhead costs. See how we just allocated the cost in a fair way? All right, are we good for that? So that was called the volume-based approach, right? That's where they give us just one cost driver. We only got one cost driver and we got one total overhead cost. So we only have one rate, one predetermined overhead rate, just one rate, one predetermined overhead rate. Can you write that down under the volume-based approach? For the volume-based approach, I want you to write down, or for traditional costing, the traditional allocation method, can you write down one predetermined overhead rate? Write down one budgeted total overhead cost. Write down one budgeted total cost driver. One, just a single one. Okay? Write that down. Because now we're going to go into activity-based costing. So with activity-based costing, costing is the process of accumulating and classifying costs to products, services, and projects. We read that already. We know again that costs are made up of the product cost is made up of a direct material, a direct labor, and a manufacturing overhead. We know that the direct material and the direct labor are easily traced. We know that manufacturing overhead is not, and so we need to allocate it. And we're gonna allocate it using the activity-based approach this time, okay? So we just learned that the volume-based approach is allocating the overhead to products using one single predetermined overhead rate. It was $6, right? $6 per labor hour. We just calculated. You see how it was just one. And it's appropriate for firms where the activities performed to make the products are relatively homogeneous across product lines, or if the company has a small amount of overhead costs. Now, activity-based costing is going to look different. The way they're going to look different is this. We have multiple cost drivers. And we're going to split up that. You see that whole activity, that whole $840,000 of manufacturing overhead? See how we just had it as just one whole thing? In activity-based costing, we split up that $840,000 into different activities. So activity-based costing splits up the whole manufacturing overhead into different activities. So if we have different activities, right, different cost drivers are going to drive each of those activities. And so if we have different activities, different cost drivers, then we're going to have multiple predetermined overhead rates. Does that make any kind of sense? So for example, if we took the 840,000 and we put 300,000 there, 500,000 there, 40,000 there, meaning that these $300,000 was manufacturing costs for the packaging activity. And then $500,000 was the manufacturing overhead costs incurred in the labeling activity. And then $50,000 was manufacturing overhead costs that we incurred in a sorting activity. Okay, so we kind of find a way to break up that manufacturing overhead costs into different cost pools. And then we find the cost drivers that drive each of those costs up. And so we have 3 different or 4 different or 5 different, depends. We have multiple predetermined overhead rates. It makes it even more efficient. Okay, the reason that we're doing it this way is because the volume-based approach is not as efficient as the activity-based approach. Then when we're not efficient at the allocation of our overhead costs, it can cause our product to be overcosted or undercosted. That means that because we might end up allocating too much overhead cost to one of our products, and that causes it to be overcosted. Or we might not allocate enough of our overhead cost to a product, which will cause it to be undercosted. Okay, so I'm gonna play this video just to reiterate the things that I'm saying. Sometimes you just need to hear it from a different voice.
Imagine you have a small takeout joint selling burgers and lemonades. This month, you sell 100 burgers and 100 lemonades, for a total of 200 items. What if, at the end of the month, you have an electric power bill of $200? How will you divide the electric bill between the burgers and the lemonades? Easy. $200 divided by 200 items equals $1 in electric power for each burger or lemonade sold. But what if you use 3 kilowatt hours of electric power to make one burger, but only 1 kilowatt hour of electric power to make a glass of lemonade? Is it still fair to write down $1 of electric power for one burger and $1 of electric power for one lemonade? We should write down a bigger electric power cost for the burger, right? This is where activity-based costing is different from traditional costing. Traditional costing is easy because it often just divides some types of costs equally between different items. These are usually costs which are a bit difficult to divide or allocate between products, such as electricity, telephone bills, internet usage, rent, salaries, and others. However, activity-based costing finds ways to divide or allocate these costs more proportionally or fairly, so that we can write down a higher cost for items or products which use more of the stuff related to cost. In our case, we now know that we should write down a higher electric power cost for burgers than for lemonades. As a result, this might cause us to sell our burgers at a higher price than the lemonades, and the lemonades at a lower price than the burgers. Of course, electric power is not the only cost in making burgers and lemonades. Therefore, we have to think about other costs as well before making our final pricing decisions. See, the basic concept of activity-based costing isn't so difficult, is it? Would you like to learn how to easily calculate product cost using activity-based costing?
All right, so did that video help to clear up anything for anyone? Anybody has any questions at this point? Okay, it helped. Great, 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 great. Okay, so basically, this is the thing that I've already said. When we use a volume-based approach, we have the overhead cost pool. Okay, it's a total plant-wide amount. So the total, just one total overhead cost that we use for the entire factory, right? This is a single cost pool, and we just use this one cost pool, and we may use this one cost driver to find the one predetermined overhead rate, and we use this to allocate the overhead costs to our products. That's what this one does, right? The volume-based approach. But then the activity-based approach says, we're gonna do things a little bit differently. We wanna be a little bit more, a lot more efficient at allocating our costs. We don't wanna undercost or overcost anything that's really gonna affect our pricing and our profits. So we're gonna make sure that we try to be as efficient as possible because we can afford to do that, right? We can afford to be more efficient. So what we're gonna do is, instead of looking at a plant-wide cost pool, we're gonna take that plant-wide cost pool and separate it into different activities that use up overhead costs in order to produce a product, right? Then we're going to use these multiple cost pools, and we're going to use the multiple cost drivers to create multiple predetermined overhead rates. That's going to give us, then we're going to use those in order to allocate the overhead cost to our product. So overhead costs for a textile manufacturer. So the volume-based approach will say, this is what the volume-based approach will say. Let us start allocating the total overhead cost pool, including inspection costs. Inspection costs is in that overhead cost pool, based on machine hours required to stitch and fasten the clothing. Now listen to this. It's a reasonable cost driver, right? Machine hours is a reasonable cost driver to allocate the cost of electricity required to run machines. That makes sense, right? So inside of this big pool of manufacturing costs, we have inspection costs, and we also have our electricity utility costs, okay? So if we think of a cost driver machine hours, it'll be fair to say the more machine hours that we use, the more electricity that we're gonna use up. The less machine hours we use, the less electricity we're gonna use up. So it's a reasonable cost driver to allocate the cost of electricity. But what about the cost of the quality inspector salaries? Is it also reasonable for us to use machine hours to allocate that cost? Not reasonable, right? Okay. So what we have with activity-based costing is we're gonna break it down, right? We have a total overhead cost, okay? Inside of that overhead cost pool, we have electricity costs, product designer salaries, quality inspector salaries. So if we can break down that big factory-wide overhead costs into different activities, electricity as an activity, electricity, product design, and quality inspector salaries. That's what we're gonna break the cost down into. But then we realize that we have 3 activities: stitching and fastening, product design, quality inspection, okay? So what's going to drive these costs up or down? So the cost driver for the first one is machine hours. Machine hours is going to drive those costs. Product design, we're gonna use design hours to drive those costs. And quality inspection, we're gonna use a number of inspections to drive those costs, okay? So this is just a snapshot of how we can break down our activities and then how we're gonna end up with how many different predetermined overhead rates will we get here? Based on what you see, how many predetermined overhead rates will we have to calculate? 3. Anybody else sees that it's 3? Great, perfect. All right, so I'm gonna let you see a video of them working through an activity-based costing question, and then we will take one up as well.
All right, so first of all, I said a while ago that the activity-based costing is more exact, is a more exact way of finding out the overhead cost of each type of phone, okay? And I said, more exact than what? Well, more exact than the traditional way. So before we move on, I'd like to make a short review of the traditional way, okay? So the traditional way is simple as this. We would simply get the total overhead cost
which we know to be $1 million, and we divide it by the total number of phones made, which was 10,000 phones. And that was for both the PDA phones and the simple phones. And by doing this, we get a very clean and easy figure or amount of $100 for each phone. So in this case, we now know, using the traditional way, that the overhead cost is about $100 for each phone. And it doesn't matter if we're talking about the PDA phone, and it doesn't matter if we're talking about the simple phone. It's the same for each phone. So it's nice and clean and simple. However, there are of course problems with this traditional way, and that's why we have activity-based costing. So what is the main problem? Well, what if the PDA phones used more machine time to be made and also needed to be quality inspected more times than the simple phone? Okay? What if that happens? Well, in this case, the PDA phone needed more overhead, and so therefore it should also have more expense. The PDA phone used the machine more, so it should pay for more of the machine maintenance. The PDA phone needed more quality inspections, so therefore it should pay for more of the salary of the quality control manager. Whereas with a simple phone, it needed less overhead because it had less machine maintenance cost, and it used the machine less, and it also had less overhead because it used less inspections of the quality control manager. So therefore, it should have less overhead and less expense. So in other words, the PDA phone should have an overhead cost which is probably higher than $100 per phone. And the simple phone should have an overhead cost which is probably lower than $100 per phone. But with the traditional way, we just make an estimate and say that for both the PDA phone and the simple phone, let's just say it's an easy, clean $100 for each phone. So this is the traditional way. It's easy, it's simple, it's fast, but it's not very exact. It's just an estimate. Okay? So it's not exact or it's not accurate to say that the PDA phone and the simple phone just have the same overhead. Okay, more from videos at MBA. Now let's remember again from the problem. What type of overhead do we find inside this box? Well, we find two types. We find the machine maintenance cost, okay, and that costs $400,000, and we have the quality control cost for $600,000 inside this whole box of overhead of $1 million. So 400,000 plus 600,000 equals 1 million. Now the next thing I want you to do, if you want, or the next thing I'm going to do is I'm going to divide this $1 million box into two parts. The machine maintenance cost part and the quality control cost part. Okay? So that's easy enough. So that way we don't confuse one with the other. You also notice that I made this side a bit smaller and this side a bit bigger, because $400,000 is smaller than $600,000. So it has a smaller part of the $1 million. Okay? So that just to make it easier to see in your brain, easier to visualize. Okay? The next thing I want to do is write down, again, from the given problem. There's no computation here yet at all. Exactly how many machine hours were used, and exactly how many inspections were done by the quality control manager. Well,
all right, so I'm gonna stop it right there, okay? So what we noticed was that what we noticed was that we had one whole overhead cost, and then they split it up into like different cost pools, okay? So the first one was machine maintenance cost, and the other one was quality control cost. And they basically split up that overhead cost into one was 400,000 and the other was 600,000. The next thing they did was they found the cost drivers. What drives machine maintenance costs? What was the cost driver for machine maintenance costs? What causes machine maintenance costs to go up? Machine maintenance cost is driven by machine hours. Good. And then quality control cost is driven by inspections. So what will be the predetermined overhead rate? Because now we know we need two predetermined overhead rates. What will be the predetermined overhead rate for machine maintenance costs? Machine maintenance cost is not driven by inspecting hours. It's driven by machine hours. So machine maintenance cost would be $400,000 divided by the cost driver. The total cost driver was how many hours? Nobody sees how many machine hours they used? 10,000, thank you. So $400,000 divided by 10,000 machine hours is $40 per machine hour. That's our first predetermined overhead rate. The next one will be the one for quality control costs. What will be the predetermined overhead rate for that? How would we find it? What would we put at the top of the formula for predetermined overhead rate? The budgeted total overhead cost of $600,000 divided by the cost driver, the total cost driver, which is 1,000, which will give us $600 per inspection, okay? So then we can already figure out if we have $40 per machine hour, then we'll just be able to multiply that $40 by the machine hours used in this product and the machine hours used in that product, okay? And if we have $600 per inspection, we'll be able to multiply that $600 by the number of inspections for this product and the number $600 times the number of inspections for the next product. And it's really broken down here. I got this from your textbook, or from the slides from the publisher already on the e-class. Step one, we break down the overhead costs into these different cost pools, activity cost pools: purchasing, raw material storage, machining, and factory supervisor salaries. And then we find the cost driver. Okay, so the cost driver, what drives purchasing costs? Number of purchasing orders. Number of square meters will drive the storage of raw material costs. Number of machine hours will drive machining costs. And the number of employees will drive the factory supervision cost. Okay, so these are our cost drivers. Okay, and then we can calculate our overhead rates, which will be cost per purchase order, cost per square meter, cost per machine hour, cost per employee. And then once we have our predetermined overhead rates, it'll be very easy for us now to allocate the overhead cost for each one to each product, okay? And then again, I have the step by step here. So imagine that if we had to identify activities that consume resources, okay, in order to produce a product, and an example of activities we can use is ordering, storage, and product testing. Then we can come up with the cost drivers that we can use. And this is a slide that gives you a bunch of different cost drivers at different levels of activity. So labor hours, setups, moves, machine hours, square feet. Those are some of the cost drivers you'll see. And then step 3, again, you see our predetermined overhead rate, and we know how to calculate that. And then step 4, we can now assign our overhead costs to our product. That is our last step, okay? I'm gonna skip this for the interest of time. So now, chapter 5, question 520, I want us to go over this question 520, and then we will take a break. Let's look at 520 part B. 520 part B. So part B says this: UU is not satisfied with the traditional method of allocating overhead because he believes that most of the overhead costs relate to the truck wheel product line because of its complexity. So it's really hard for us to produce the truck wheels. So we think that most of our overhead costs should be allocated to the truck. But before, we saw that most of it was allocated to the car. So they're saying right now, as is, when we did part A, which of these products is overcosted? Cars is overcosted, exactly. And the truck is right now is overcosted. So we need the truck to absorb more cost. He therefore develops the following 3 activity cost pools and related cost drivers to better understand these costs. Okay, and in your exams, you will be given the cost pools and you will be given the cost drivers. So don't worry about having to make those up yourself, okay? So the 3 pools he had here, so he's saying this $840,000, he's gonna break it down into 3 parts. Setting up machines is the first activity cost pool, assembling and inspection. He estimates that setting up machines, the estimated overhead cost is $260,000. For the assembling activity cost pool, it's $280,000. And for the inspection cost pool, it's $300,000. Then he gives us the cost drivers. He says, setting up machines is driven by setups, okay? Assembling is driven by the labor hours. And the inspection activity is driven by the number of inspections. He even tells us how many setups were used, how many labor hours we used, and how many inspections we used in total. This is the total setups, labor hours, and inspections, okay? How many predetermined overhead rates are we going to calculate? 3, what is the predetermined overhead rate for setting up machines? Drop your answers in the chat. 520. Okay, so I'm gonna use my calculator to confirm. 260,000 divided by 500 is 520. Everybody else got that? Great, great. Now, what is our predetermined overhead rate for assembling? 8. Everybody else got that? Great, 280,000 divided by 35,000, perfect. And our predetermined overhead rate for inspection, 500, okay. Now I like that everybody is just saying 500, 8, and the other one was what? 520. You're just saying $520, $500, $8. But I want you to say it per $500 per what? Inspections, predetermined overhead rate is $500 per inspection. Assembling is how much? $8 per labor hour. Okay, don't just say per hour because it could be machine hour, it could be labor hour. And then setting up machines is $520 per setup. Exactly. So we know our rates, okay? We know our rates. I'm gonna bring it over here now so we can really see. Good. So we can really see what's going on here. So we got some rates that we already figured out. The first rate we got was $520 per setup. Then we got $8. Was it $8? I forget. Yes, $8, okay, per labor hour. And then we got $500 per inspection, okay? So we got the rates, right? And these are the different rates for each of our activities, right? So if we want to figure out how much of the hold on, let me get the actual name of the cost pool. How much of the setting up of machines, assembling, inspection. I'm gonna write that down too. Setting up of machines, assembling, inspection. So these are our activities, and these are our rates. Okay. So how much of setting up of machines is allocated to our car wheels? How do we find that out? Who thinks they know? Setting up of machines, $520 per setup. How much goes to the car? Right here. The car wheels. 52,000. Okay, what else do you get? 52,000. Ria got that. I cannot rock. Soliana, I hope I said your name properly, said 52,000. Anybody else have an idea of what? Yeah, 520 minus multiplied by 100. Good. Yes, good. Now, how much goes to trucks? Good. Now, what about assembling? How much overhead it goes to cars for assembling activity? 160,000. Okay, anybody else got that? Great, 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 great. And how much goes to the truck for assembling activity? All right. How much is gonna go to inspection for the cars? Great. And how much is gonna go to the truck wheels from inspection? Perfect. So now that we have all these different costs, we can find out the total overhead for car and the total overhead for the truck wheels by just adding up all of those activities under each one. And it's going to look like this. So we calculated in part B, we have here our predetermined overhead rates. And then we calculated all these numbers just now. And this is what our total overhead assigned to our car wheels and our total overhead assigned to our truck. And now the truck is no longer undercosted and the car wheel is no longer overcosted. We understand this? Activity-based costing and the volume-based one. One predetermined overhead, multiple predetermined overhead rates. Are we okay with that? Yeah? Anybody has any questions? All right, so then I'm not gonna go through this. I'm gonna leave this in the slide. It's just theory. What are the benefits of activity-based costing? What are the limitations of it? Okay, and then which method should we use? I'm gonna leave this one up to you as well, okay? As well as the classification of activities. I have these slides here for you to look over, and we can have a break now. Okay, so we talked about this last week. I remember we were saying whenever the number of units produced increases, then per unit variable cost stays the same, but variable total cost changes. whenever the number of units we produce changes, fixed costs will stay the same per unit. But the total fixed cost will stay the same, but per unit fixed cost will change. Okay, so this is just a quick table that I put in there just to help you remember and understand that. For this one, I have a bunch of different costs under here that we can talk about. I'm not going to do all of them, just a couple of them before we move on to the next slide. So wood used in chairs, if it was an Oakland company, it's a furniture manufacturer. The wood used in chairs, would that be a fixed cost, variable cost, or mixed cost? Wood used in chairs, is it variable, fixed, or variable cost? Some people think it's fixed. So the reason why it's going to be a variable cost is because it's a direct material cost. And what happens is that the more of the wood that you use, then the higher the cost is going to be. So a cost that changes with the number of units is going to be considered a variable cost. So if we increase the number of units that we produce and that cost goes up, then it's variable. Okay, if we increase the number of units that we produce and that cost stays the same, then it's fixed. Salaries of inspectors. If we produce more, does the salaries of inspectors go up? Some people say it's fixed. It might stay the same no matter how many they inspect, but also it can also go up. It could also be like on commission. So it could be part fixed and part variable, right? They have a fixed salary no matter how much they inspect, but then if they go above and beyond a certain amount, then maybe there might be some variable aspect of it. So this can fall under both a fixed cost or a mixed cost, but I can put it on the fixed at this point. Right, another one is here is a factory rent. Is that fixed or variable? What about depreciation on machinery? Does it matter how much we produce? Or property taxes? Will that be fixed or variable? Fixed, okay. All right, so that just gives us an idea of fixed and variable, understanding that it's if we increase the number of units that we produce or we sell, is that going to cause variable costs to go up? Is that going to cause the cost to go up? If the cost goes up, it's variable. If we reduce how much we produce or sell and the cost goes down, it's variable. If we increase how much we produce and the cost stays the same, it's fixed. And a combination of fixed and variable costs together is called a mixed cost. Okay? The cost volume profit or break-even analysis, another way of saying it, it looks at the effects that changes in the following will have on profits, short-term profits. So if the selling price changes, how is that affecting profits? If fixed costs and variable costs change, how is that affecting our profit? If the volume, which is the number of units we produce, change, then how does that affect our profits? And the sales mix, meaning how much of one product we produce over another, if that changes, how does that affect our profits? Because some products earn us more profits than other products, right? So that's what the sales mix is really talking about. How can we calculate operating income or profit? So to calculate that, we can use two different approaches. We can use a profit equation or a cost volume profit model. Another way we can do it is by using a contribution margin income statement. And correct me if I'm wrong, this is probably your first time hearing the word contribution margin or the second time. Contribution margin income statement. So contribution margin is our variable cost less our fixed costs. Okay, but before we do that, let's put on our math caps, right? Put on our math caps and let's look at this formula. Profit is equal to sales less total cost. Sales less total cost. We can break down that formula even more by saying that profit is equal to sales minus variable cost minus fixed costs. Okay, because total cost is made up of variable costs and fixed costs. So we deduct the variable cost and then we deduct the fixed cost. That's the same thing as saying take away total cost, but we're just breaking it down. Operating profit, now we can break that down even more by saying profit is equal to, how do we find sales? Sales is the selling price per unit times the number of units sold. Okay? And then we can even break down the variable costs. We can say variable cost per unit times units sold minus fixed costs. So on this page, I'm just showing you how we can break down a profit equation. Break it down so you can really see the parts that are affecting profit. Selling price per unit affects profit. The units sold affects profit. Variable cost per unit affects our profit. Okay, so as sales changes, total cost and therefore profit will also change, obviously. Okay, we know that if sales changes, then our profit will change, but also know that if sales change, your total cost will also change. So the contribution margin income statement was the other way I talked about that we can use. So here we have the equation and we have the income statement. This is the equation and this is the income statement. The income statement separates mixed costs into fixed and variable. Remember I said mixed costs is a combination of fixed and variable costs. So this income statement is saying we're not going to say revenues or sales less total cost anymore. No, 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 no. We're going to separate them out. So revenues less variable costs equals a contribution margin. And the contribution margin less our fixed cost is equal to an operating income. Now, what does contribution margin mean? Contribution margin shows us how much money we have left over after we have paid our variable costs to pay our fixed costs, and then maybe still have a profit at the end. If you notice here, contribution margin is telling us how much do we have to cover our fixed costs. Do we have enough to cover our fixed costs and maybe even make a profit? Contribution margin is telling us what do we have, how can we cover our fixed costs? Okay, how can we cover our fixed costs? Sales, we have sales, that's our variable cost, gives us a contribution margin, right? Now from our contribution margin, do we have enough to pay off our fixed costs and still make a profit? Anybody understands or has any questions for contribution margin? Are we good with contribution margin? Sales less variable costs? How much is left over for us to pay off our fixed costs? We're okay with that? Just Kansai is okay, everybody else is confused? All right, so sales less variable cost is our contribution margin, and after we deduct our fixed costs from our contribution margin, we can see if we can have any income, any profit. So Vargo Video Company produces DVD players. Again, I took this from the slides on eClass. This is the relevant data for June. Unit selling price of DVD player, $500. Variable cost is $300. What is your contribution margin per unit? $200, perfect. Anybody else knows that or just Kanza? Oh, also Shengshu, okay, perfect. So $200 will be our contribution margin. Our fixed cost is $200,000, units sold is 1,600. So this is an income statement right here. We see that sales will be 1,600, right? And we're going to multiply that by the selling price per unit. So 1,600 times 500 will give us $800,000. Less our variable costs. Our variable cost will be what? How do we find our variable costs? $300 per unit times 1,600. Very good, Kobe. So this gives us 480,000. And once we deduct that, we get our contribution margin in dollars. So total contribution margin is $320,000. And as we said before, the per unit contribution margin is $200. 500 take away 300. Now we have $320,000. That $320,000 has to pay off fixed costs first. That's the first thing we need to do, pay off our fixed costs. Once we do that, we cross our fingers and hope we have a profit. Okay, in this case, we do have a profit of $120,000. So a company can achieve an increase in contribution margin if fixed cost decreases, selling price decreases, fixed cost increases, or variable cost decreases. What will cause our contribution margin to increase? I have fixed costs decreasing and variable cost decreasing. The answer is actually D, okay? Variable costs, if variable costs decrease, remember, contribution margin is sales less variable costs. So if sales is $10 and variable cost is $5, then contribution margin is $5. But as variable cost decreases to $3, then 10 take away 3 will be $7. So that's going to cause your contribution margin to go up if variable cost decreases. People who said A, do you understand that?
Yeah, sorry, I confused it with the operating profit.
Okay, perfect. So we have the calculating contribution margin, different formulas here. You can do it as a per unit basis. So contribution margin per unit is equal to the selling price per unit minus the variable cost per unit. We did that. Or you can have the total contribution margin, which is your revenues less your variable costs. We also did that. The one that we're now seeing for the first time is our contribution margin per unit times the number of units sold, but that makes sense, right? If we have the per unit contribution margin and we know how much units we've sold, then that's gonna give us a total contribution margin. And then a contribution margin ratio is our sales less our variable cost. So in other words, it's contribution margin divided by sales.
Contribution margin is the difference between sales revenue and variable cost. It allows a company to determine the profitability of individual products by measuring how sales affect profits. In its ratio form, it is calculated as contribution margin divided by sales revenue. While revenue from a company's product is how much money the company makes from selling that item, a product's variable costs include those expenses that vary depending on the company's production volume. A business owner, Ida, might use contribution margin figures to decide which product's costs he should reduce or which price he should increase. For example, if a pair of jeans sells for $100 and its variable costs are $65, its contribution margin is $35 or 35%. This means that for each dollar of sales, profit increases by 35 cents. Ida wants to see a contribution margin ratio of 50%. He determines he can achieve this either by reducing variable cost to $50 by increasing the price of jeans to $130 or through some combination of the two. Another option is to quit selling jeans entirely and focus on other products, such as button-down shirts, which already have a contribution margin of at least 50%. Ida might also want to calculate the contribution margin for all of his products in sum. If total variable costs are $750,000 and total sales are $1.5 million, the total contribution margin in ratio form will be 50%. The business could compare the contribution margins of individual products against the company's total contribution margin to determine which products to sell more of and/or which to sell less of. If dress slacks have a contribution margin of 60% and it is possible to sell more of them at the same price, total contribution margin will rise.
All right, so that video just showed us different ways that we can use the contribution margin in order to—
Let's talk about what a contribution margin is in the
in order
context
to
of
make different
accounting.
decisions.
So let's say that you decide you want to make bicycles and you rent out.
Okay, so we can use a contribution margin amount to make different decisions. Okay, so another thing that we use the contribution margin to do is that we use it in order to come up with our break-even point, and we're going to get into that next. But I wanted just to say this last point on the contribution margin. So when we calculate the contribution margin, we say here, if the sales increases by 100 units, let's just imagine, if sales increases by 100 units, then we can use the contribution margin per unit to find out how much profit will increase by. And what we'll do is that we'll multiply the increase in the sales by our contribution margin per unit. All right. And like the video said, a contribution margin ratio, which I said before is our contribution margin divided by our sales, can tell us, for example, if it's 40%, it says that for each dollar of sales, there is 40 cents or 40% of the dollar left over after deducting variable costs to contribute to our fixed costs and our profit. All right. So that is basically what the contribution margin ratio is telling you. What percentage can we contribute to our fixed costs and our operating income? Okay, so let's move into how we're going to talk about our break even now. So look at this. To cover fixed costs of $200,000, okay, 200,000, Vargo Video must sell 1,000 DVD players, okay? So 1,000 DVD players times $500 per unit is $500,000. Less our variable cost of $300,000 gives us a contribution margin of $200,000. 200,000 of contribution margin less our fixed cost gives us an operating income of $0. What do we call it when we have an operating income of $0? When we only have enough contribution margin to cover our fixed costs, that's it, and we have a $0 operating income. What is that called in accounting? Break even. Very good. So that is what break even is, where our profit is $0. Our sales is equal to our total cost. Now, every DVD sold above the 1,000. So remember before we were selling 1,000 to make $0. So you can imagine if we sold 1,001, right? 1,001 DVD players, now we're probably gonna make a profit, right? We should, right? We should make a profit if we sell 1,001 DVD players, right? If selling 1,000 makes us break even, what will happen if we sell 1,001? Would we still break even? Will we make a loss? Would we make a profit? What do you think? If we sell one more, Kansas thinks we'll make a $200 profit. Anyone else? Okay, Colby agrees. All right. So that's correct. We're going to make a $200 profit, and that's because for every increase in the units sold, we will make the contribution margin per unit, and we said that before. So that's why with selling, with selling 1,001 DVD players, we now make a profit of $20,200. Sorry, we make a profit of $200. Everybody clear on that? Great. So the contribution margin ratio, as we said before, shows the percentage of each sales dollar available to apply towards the fixed cost and the profit. And again, I said to calculate the contribution margin ratio, you have the contribution margin per unit and you divide it by your unit selling price. That's going to give you a contribution margin ratio. So if Vargo Video sales increases by $100,000, net income will increase by 40% of that. So if we sold $600,000 instead of $500,000, okay, what's going to happen is that we're going to multiply that increase of 100,000 by 40%, our contribution margin ratio, and that's going to tell us how much our increase in our profit is going to be. So we see how we can use our contribution margin per unit and our contribution margin ratio in order to find out how our profit is being affected. Cost, volume, profit analysis. So contribution margin is sales revenue less variable costs, sales revenue less fixed and variable expenses, fixed expenses less variable expenses, or sales revenue less cost of goods sold. Cancer thinks it's A. Anyone agrees? A for Ria, A for Indrajit, A for Roxoliana. Okay, Perfect. A is correct. Good. So now we're at, how do we calculate the break-even point? Break-even point again is where total revenues is equal to total cost. It tells us our profit or operating income is $0. We can calculate break-even point in two ways. We can calculate the break-even point in dollars, or we can calculate the break-even point in the number of units produced or sold. If we calculate the break-even point in dollars, we're asking how many sales dollars must we earn to break even, or how many sales dollars must be earned to make a profit of $0. If we find the break-even point in the number of units produced or sold, we're asking how many units must be produced or sold to break even. Yes, that's correct. So that brings us to this slide, our formulas. Okay, we need the contribution margin per unit and we need the total fixed cost. So total fixed cost divided by contribution margin per unit is going to tell us our break even in units. But a total fixed cost divided by our contribution margin ratio is going to give us our break even in sales dollars. And now we know from before, we already learned how to calculate our contribution margin ratio, which is our contribution margin per unit divided by our selling price per unit. Or if we know the break-even point in units from up here, we can just multiply it by the selling price per unit to get it the break-even point in sales dollars. Here's an example. Big Man Inc. is a company that produces brooms. Each broom sells for $20. Can you take a picture of this slide so you can use it to answer the next question, please? 5, 4, 3, 2, 1, 0. Okay, so Big Man Inc. is a company that produces brooms. Each broom sells for $20. The variable cost per broom is $12 and the fixed cost per month are $40,000. What is the annual break-even point in units? So the break-even point in units, as we said before, it's going to be our total fixed cost divided by our contribution margin per unit. So what is our total fixed cost? Or maybe give me your break-even point in units amount. What do you come up with? Okay, so our total fixed cost is $40,000. And we're going to divide that by our contribution margin per unit, which is, for those who didn't get to see the slide, what is our contribution margin per unit? 8, very good. So 40,000 divided by $8 is equal to 5,000 units, right? Great. So what is the break even in sales dollars? Well, we can find it using two ways. If we know the break even point in units, we can just say 5,000 units times selling price per unit of $20, right? Is that correct? Good. So this is how much it will be in dollars. Another way we do this is by finding the contribution margin ratio, right? So that's this one. So we still use the same total fixed cost and we divide it by the contribution margin ratio. So can somebody find that for me? What do you get? So we still use the same $40,000, but this time I'm gonna put the big or here. We're gonna divide it by, what's the contribution margin ratio? 40%. Okay. How do we find the contribution margin ratio? What did we do? Let's break it down. Contribution margin ratio is the contribution margin per unit divided by the selling price per unit. So the contribution margin per unit is 8 divided by Selling price per unit was 20, which is equal to 0.40. Okay, $40,000 divided by 0.40 is equal to $100,000. Are we okay with this? Kansas good? Anyone else good? Ria, Effie, yes, perfect. So here we have a cost volume profit chart. And what this says is that we have this line right here that starts from 0 going up is our sales line. This line here is our total cost line. And then we see our fixed cost line. But where our sales cost and our total cost intersects is our break-even point. Okay, and if when you get the slides, if you want to look at this video to see a little bit more about how people use these charts in order to make decisions, you can do that, okay? The last thing I'm gonna do for today is a targeted profit or income. Everything else that we haven't covered, I'll do it in a supplementary video that I will post on the e-class by this weekend, okay? Yes, I will do that. So targeted profit or income revenue planning, okay? This is what happens with the break even, is that we can use the same break even formula to find out how much do we need to sell, not just to break even, but also to make a specific profit. And all you do is you alter the equation and you put fixed costs plus what is the targeted profit divided by the contribution margin per unit. So this is what the formula can look like. Q is equal to fixed cost plus targeted profit divided by selling price minus variable cost per unit. Yep, I will post the slides very, very shortly. I'll post it in the group chat. So this is how we can do an example here. New York Limited sells its product for $24 per unit and variable costs are $14 per unit. Fixed costs are $130,000. Calculate the required sales in units to achieve its targeted operating income of $60,000. How will we, what am I doing? How would we do this one? Considering the formula I just showed you, you just have to add the targeted operating profit to your fixed cost. So what will we do here? What do I write? How do I find the required sales in units to achieve the target operating income of $60,000? Units at targeted profit. Fixed cost plus targeted profit divided by contribution margin per unit. So what do I do here? Fixed costs plus targeted profit divided by contribution margin per unit. So that will be equal to, so 130,000, thank you, plus 60,000 divided by 24 minus 14. Okay, so that's going to give us, so how much units do we need to sell in order to make that profit? 7,000 units? Anybody else got 7,000? So 130,000 plus 60,000 gives us 190,000. 190,000 divided by 10 will give us a total of 19,000. Wait, I'm getting different numbers here. What's going on? How come we're getting so many different ones? Okay. Effie, you scared me there. I thought maybe, I don't know. All right, so are we good for break-even point in units? Finding the targeted sales in units that we need. Are we okay with that? All right. So target profit or income cost planning. So the manager knows the sales volume and the desired profit. So if the manager knows these, but now we want to be able to find out the required variable cost unit or total fixed cost needed to achieve a desired operating profit. Now, friends, listen. You see these equations over here. If a question asks you for variable cost per unit, then you're just gonna plug in the others and solve for this. Okay, if they ask you for selling price, then plug in the others and solve for selling price. All right, so if you're asked to find one of these, you're just going to use this formula and plug them in. So whenever you come up on any questions that's asking you about what should be the variable cost per unit to achieve this targeted profit, just use this formula and plug in the numbers that you're given. Okay, so I'm gonna leave it here for now. When a couple of slides talks about the sales mix, which is very simple. It's just talking about companies sell more than one product and they have to decide how much of each product to sell so that they can get the best profit. Okay, but what I'm gonna do is, just because it's like pretty late and everybody seems to be very tired at this point, I'm going to just drop the link to the slides in the chat. One thing I wanted to mention, there's something in chapter 5 that deals with activity-based costing in the service industry. Activity-based costing in the service industry. Take a read of that on your own, please. Activity-based costing in the service industry. Take a read of that on your own. And also, can you refer to the fall recording of the lecture recording that Taslima has posted on there as well. All right, so I'm sorry for all of the information I have to jam down your throats in one night, but that's it for today. I will send you, I'll post that video by this weekend.